I've been meaning to make a video for a few days now, thinking I've got enough material, new, very fresh information that will help you decide what you think the next move in the property market is, and only to find out that each and every day there was more and more, like a pretty much an avalanche of information coming my way, and I am going to try and get all that information in this video. We got a couple of videos to share with you, and I also have an article to read out to you from Roger Montgomery. But the trend, in short, that I can see currently happening is that the officialdom is seem to be preparing us for some sort of a crash. What do I mean by that is that people like, just to quote Greg Medcraft from ASIC, Australian Securities Investment Commission, who was quoted in Australian Financial Review as saying, "I have been saying for a while I thought it was a bubble, and other people are catching up now." Now, he is an official working for the ASIC, which I believe is the government, part of the government department organization. So for him and other people, and you'll see it in this short video I got for you, for them to be saying this tells me that they are wanting to cover their backside. So when there's a property crash, they'll be saying, well, we warned you, we told you not to borrow more than you can, we warned about the overheated property market, and we provided solutions. We said, you should, we told government to cut the capital gains discount rate, to do these other measures, etc., etc., full well knowing that the government was never going to do anything about it. So I think that's the trend, and you tell me what you think after we go through some of the latest information.
New Reserve Bank Governor Philip Lowe may well be losing sleep. In its latest report on financial stability, the RBA highlighted concerns about household debt and the volatile mix of home lending to vulnerable households, which threatens to undermine the economy. At least the threat posed by softening jobs markets became slightly less acute as the latest job numbers displayed a degree of resilience. Here's finance correspondent Phil Lasker.
Don't be fooled by a smiling Reserve Bank Governor Philip Lowe. The evolution of the RBA's thinking since the last half-yearly financial stability review has been profound.
Last October, the RBA was sort of telling us they were not particularly worried about what was going on in housing. They weren't really worried about the state of household balance sheets, and clearly a lot has changed over the last 6 months.
Like a surge in big city house prices, fueled by what the RBA sees as low interest rates, riskier loans and property-friendly tax laws. Its half-yearly assessment of the financial system concluded that vulnerabilities related to household debt and the housing market have increased. What's more, 1 in 3 borrowers has limited or no repayment buffer, so if they were to lose their jobs, they'd only be able to make a single loan repayment at the most before defaulting. This is a relatively large pool of new and lower income borrowers who are more vulnerable to mortgage stress.
You could run the risk then that financial stress does rise, or that particular household has to dramatically reduce consumption. If enough households reduce consumption sharply, then that can have an impact on economic activity.
Rising house prices are also blamed for the build-up in household debt as people are encouraged to borrow more. Also worrying is the concentration of investment loans among highly indebted households, pumping up prices and increasing the risks of a big fall.
At the moment it feels like it's not a problem, but what we do know is that things change and can change quite rapidly. So if rates were to rise, or if the economy for whatever reason was to be subject to some sort of shock, then I think these sort of issues would become problematic for us.
At least.
Before we go on to the next video, the next piece of the puzzle is actually from Roger Montgomery, who is not really the officialdom, although you'll see his face on TV, Sky Business News, a lot, but he doesn't work for the government. So he's been calling for the property decline for a long time, and his argument is pretty much well established, and I completely understand it, is that as a value investor you start to begin to realize that something is overvalued a lot earlier before the rest of the population actually realizes that. So you get out of that market, or you don't get onto the market because you think it's overpriced, and as a value investor you wouldn't buy something that you think is expensive. You wouldn't just buy it because you think it's going to continue to go up, yet you know it's expensive. I mean, I know myself, I'm not going to pay more than it's worth for a car. For anything else, you go to the supermarket, you know, you're not going to pay more than what you think it's worth. Yet people have been doing it exactly that in property for 10, 15, arguably you could say 20 years. For at least about 10 years, I thought that property was overvalued, same as Roger Montgomery. So he goes into this article titled, "Are We Wrong on Property?" If you are one of the tens of thousands of investors who have been reading our blog since the beginning, you'll know that we are value investors, and one of the downsides of value investing is selling early. It is inevitable that we will think prices are ridiculous long before others do. This was indeed the case when we called in 2010 an end to iron ore boom. So on March 4th, 2010, we wrote, so I'm not going to read that whole thing, that basically said that the price was going to go down, and then going back to the article, at the time iron ore was trading at $140 a ton, and by April of that year it had hit $184 a ton. Had you been prompted by our post and sought advice before selling out of iron ore in March 2010, you would have missed the run up to $184 a ton, and you could say that we made the wrong call by being early. But iron ore has since fallen to as low as $37 a ton. So would you conclude we were right? Then he goes on to say that it's not about the price, but it's actually about the value. Again, going back to what is it actually worth, not what people are paying for it at the time. So he goes on to say, value investing, however, cares much about values than it does about prices. And because we are dealing with fundamentals which move much more slowly than prices, it is inevitable that value investors will look very wrong from time to time. So then he goes into the Berkshire Hathaway, which is Warren Buffett's company, in a run-up to year 2000, which we all know was a dot-com bubble. So what he's saying is that, and I remember that mums and dads and people quit their jobs to trade on the stock market because it was so easy to make money. So this green line shows you the stock market at the time, and that compares to the Berkshire Hathaway, Warren Buffett's investment company, share price in the run-up to the, this is the middle of the, or 1999 up to 2000. So the share price doesn't look good. So the overall market, or the best ever investor in the world, is underperforming the market. So how can that be? So they were calling Warren Buffett an investor who has lost his way, who hasn't kept up with the times about .com, about the companies that were valued at billions and billions of dollars, the nosebleed values, but were not making money, were not making profit. So he knew this was a bubble that was going to burst. So he never bothered to enter the market, because obviously he didn't want to lose money. And then what happened after the crash is that this green line is again your Nasdaq, I believe. So it's your, and then the Berkshire Hathaway, the company, is the chart that keeps going up and up and up, which means that in the long run the value investors will always come out on top. And in Roger Montgomery's words, going back to the article, what I think is hilarious, if it wasn't so worrying, is that in 1999 Buffett was a washed up investor who knew nothing about the new paradigm. However, 2 years later, at the end of 2001, he was a genius, and yet between those two labels he didn't change a thing. Back to the article. So back to property, and we have been warning about the emergence and growth of a bubble in house prices since 2013, and once again we have been early. If you only look at prices, you'd argue we have been wrong, but the fundamentals we discussed in those early warnings, such as burgeoning household debt to income and GDP and oversupply, have only deteriorated further since we first started arguing the makings of a bubble were emerging. My good friend Hamish Douglas once observed, "It's better to be 6 months early than 6 minutes late." Importantly, our warnings are now being echoed by the likes of Greg Metcalf from ASIC, who is quoted in today's The Australian Financial Review as saying, "I have been saying for a while I thought it was a bubble, and other people are catching up now." Yesterday, Rob Simon, a real estate agent with Richardson and Wrench in Mossman, Sydney, noted it was only a matter of time before some property punters would cash in simply because property data is now pointing to a significant price correction. The latest Reserve Bank of Australia RBA data has inflation-adjusted wage growth sitting most uncomfortably around zero, which spells disaster for households carrying excessively large mortgages. Time to cool the heels, cash in, and lock oneself into a lease for 24 months or so, and watch what happens, as there are some worrying signs out there, although some areas will see minimal change and others massive. And that's from a real estate agent. Most worryingly, Scott Morrison, which I believe is the treasurer at the moment, is making off like Pontius Pilate and washing his hands off the whole property bubble burst affair by telling the banks they shouldn't raise interest rates, but knowing full well he has no command of global bond rates and the bank's cost of funds. So again, you know, it wasn't my fault. The government's going to try and blame banks, that's for sure, that's 100%, where the government contributed so much more largely than the banks to this whole disaster, which I think it's going, and I'm not the only one who thinks is going to occur. Again, this is my opinion, this is my research, this is the only stuff about the property that is coming my way. There is nothing positive about property. The interest rates are not going down, the wages are not rising, it's not getting any better. But watch this next video, and that'll probably cement your opinion as to what is going on at the moment.
In the big cities, a good job and decent pay doesn't count for much when you're searching for a first home.
Got a fairly good wage, so it's even though it's still, I guess, difficult to try and get something in your price range without compromising.
We're fortunate enough to be able to get a little bit of help, and even with that help, it seems like we're falling short of what we need a lot of the time. So, yeah, times are tough.
These long-suffering first home buyers would not be happy to see the National Australia Bank's quarterly property report.
Sentiment around the property market remains quite elevated. Actually, it's picked up in the quarter, and that's a reflection of positive expectations for prices.
Prices have streaked ahead in Australia's biggest cities. The increase in Sydney prices since 2009 is nearly 110%, while Melbourne has seen a 92% rise. That's coincided with a big lift in household debt, which is now over 180% of disposable household income. And there's a swarm of investors who've descended on the property market, encouraged by the tax advantages.
It really is quite sad. We have more investors than first buyers. My personal opinion is that, how many investment properties do you need to live off it at the end of the day? I think negative gearing should stay. However, my personal opinion, feelings about it are that, 5 properties would probably be enough for an investor, and yet many investors I talk to got between 15, 20 properties negative geared.
Many of these borrowers are taking out the riskiest of loans. There's a strong correlation between interest-only and investor loans. Is it any wonder the most senior policymakers have become more public and explicit in their warnings about housing?
The longer the recent trends continued, the greater the risk to the future health of our economy.
Even though the steps we've taken have had a positive impact, the risk environment certainly hasn't moderated.
This doesn't worry the National Australia Bank. The home lender doesn't see a trigger for a housing collapse.
To get a drop in the ability of households to make repayments, you actually need a substantive rise in either the unemployment rate or interest rates. And neither of those scenarios are likely at the moment, at least based on our current forecasts.
Yet Treasurer Scott Morrison, reluctant to describe the property market as a bubble, is conscious of a market that is precariously balanced.
Using the scalpel to deal with these sorts of issues is much more preferable than using the sledgehammer.
But the Taxation Institute's Bob Deutsch says something akin to a sledgehammer may be the only viable solution at this stage.
We have a massive housing affordability problem, particularly in the Sydney and Melbourne metropolitan regions. That needs to be addressed. To say that we don't change anything because we have this fear that change is going to have some consequence that we can't quite anticipate, I think that in itself is fraught with danger.
The Institute says the capital gains tax concession should be halved to 25%.
If you take away the capital gains tax discount or part of it, it overall makes property investment slightly less attractive. So the incentive to get into a geared property would be reduced.
Bob Deutsch says the current capital gains tax discount is way more generous than indexation ever was.
The CPI change over the last 10 years would be nowhere near 50%. They'd be more likely to be in the region of 10 to 15% over that entire period of time.
First home buyers remain in the dark about what to do and who is to blame.
I've heard the overseas buying as well is obviously pushing the house prices up, which is great if I'm already in the market, but I'm not.
I'm not saying that there's a clear solution, but there's definitely a problem.
And don't our most influential policymakers know it?